Hey everybody, it's Jack and welcome back to another portfolio update video. In today's video, I'll be diving into all of the stocks that I've been purchasing over the past few weeks. I'll show you all of my positions as well as just breaking down how my strategy has been evolving with the current market scenario. So lots to go over in this video, but just quickly, if you're new to the channel and wondering what exactly I'm doing, I'm currently undergoing a WealthSimple challenge where my goal is to bring a $1,000 account up to $100,000 through saving like crazy and smart investing. So I invest around $200 into this account every single week in order to dollar cost average into the stock market over the long term, where the end goal is to one day potentially retire off of this account. I use WealthSimple for this because it's one of Canada's only $0 commission trading platforms. So it's a great for beginners, and I highly recommend, if you are not using WealthSimple, to make the switch. You're going to save so much money on commission costs. And there's actually a great promo right now for WealthSimple. So now's a great time to make that plunge. I'll put a link down below in the description of this video, where if you actually sign up using that link, you'll get 3 free stocks. And these stocks could be anywhere from $5 in value all the way up to an Amazon, so over $4,000 Canadian. So again, this is a great promo and it's only until the middle of October, so definitely don't miss out. And quickly touching on the stock market in general before we dive into my portfolio, there has been a little bit more of shakiness in the stock market over the past few weeks. We've started to see, that hot run come to an end. We saw a little bit of a dip, especially early on in this week. So it was a great opportunity to potentially buy some of your favorite stocks on a little bit of a discount. So hopefully you took advantage of that. And then the stock market did recover near the end of the week. The US stock market, the S&P 500, finished up, or I think 1% on the week. And the Canadian stock market was just behind that at just over 0.5% gain. So with all that being said, let's now dive into my account status. So my account currently sits at $10,463.70. On Friday, we were actually down $32.78 or 0.31%. And my account was actually down on the week. We were down $47.14 or 0.45%. And the main reason for that being a few of the larger positions in my portfolio didn't have the strongest of weeks. So it definitely had some buying opportunities for me to pick up a few shares. And I'll get into exactly which companies these were later on in the video. And the actual month, we're just about break even over the past month. So not a whole lot of change. And if we actually look at all time, we are now still up 4.5% or $453.78. So this is quite a bit of money that we've gained over the past few months, over $400, almost $500. And this is really why I tell anyone to just start investing, start and pick it up as you go. You'll learn along the way, start small and really just chip away. Time in the market beats timing the market. And as a beginner, it's crucial to just get that journey started. So now that we've covered my account status, let's actually jump into my spreadsheet where I track all of my positions, and we'll talk about what I've been purchasing, have I been selling, and what my strategy is moving forward. So we are now in my spreadsheet where I track all of my stock positions, my passive income from my dividend stocks, as well as a couple charts to kind of show in a really nice visualization how my portfolio is broken down. But let's start off by going through all of my positions and really just highlighting the ones that I've been adding to over the past few weeks. So starting it off at the top with Algonquin Power and Utilities. Over the past few weeks, I think I've picked up 2 more shares of Algonquin Power. As you can see, the current share price is at $19.17, which means Algonquin has seen a little bit of a dip over the past few weeks. It was trading around $20 per share a few weeks ago. It's now down closer to $19, so around a 4 to 5% drop. And as you see, my average cost is around the $20 mark. So I've been continuing to dollar cost average lower into this position as a long-term investment and just picking up a few shares as it stays below my average cost. So I now have 42 shares of Algonquin Power, and it makes up 7.4% of my portfolio. So it is one of the larger positions in my account. The next stock that is a substantial position in my portfolio, and also one that I've been adding to over the past few weeks, is TD Bank, or Toronto Dominion Bank, ticker symbol TD. This is one of Canada's big banks, and it is one of my favorite Canadian dividend stocks to buy and hold. I really don't think you can ever go wrong with buying TD. And I'm currently down on my position 1.5% as my average cost is $84.60 and it's currently trading at $83. However, it even dipped even lower than this. It went down to $80 per share. And I think if you can get TD close to $80, this is a great stock to buy. I have 11 shares of TD and it currently makes up the largest position in my portfolio at 8.4%. I also love the banks at the current prices because, as you know, there are regulations on the banks and they actually cannot raise their dividends currently. So they are all sitting on really large cash positions. So as soon as the regulations are lifted, hopefully soon, I think we're going to see a really nice increase in the actual dividend payout of all of the big banks, which makes these bank stocks even more attractive in my eyes. The next stock I've also just slowly been dabbling at adding to is Manulife Financial, ticker symbol MFC, another stock that is in the financial sector. And this is one that's an insurance company, and it too is a position I'm down on. So I've just slowly been adding to it to dollar cost average and bring my average cost down. Manulife is another great Canadian dividend growth stock that raises its dividend on an annual basis, as well as seeing share price appreciation. It's a really nice balanced dividend growth stock, and it currently makes up 5.8% of my portfolio. And the next stock that I've been adding to is another dividend stock. It's TELUS, ticker symbol T. This is one of Canada's largest telecom companies, and it's one that I've been adding to consistently since I started this investment journey. I currently own 29 shares of TELUS. It is one of my larger positions at 7.6%, and this is a great dividend growth stock again. It currently has a dividend yield around 4.4%, so you're getting a great starting yield. So that is it for all the dividend stocks I've picked up over the past few weeks. Let's now get into my ETF and growth stock positions. So as you know, or you may not know, I mostly have for my growth stocks, I mostly have small cap stocks that I think are really great for the next 5 to 10 years and might see exponential growth. These are ones that I have been holding. They haven't been doing too well as of late or since I started this journey. However, they're ones that I really am passionate about, like I said, for the next 5 to 10 years and really think are going to do well in the big picture. And then in terms of my actual other growth stocks, I get my large cap growth stocks through my ETFs, through my NASDAQ 100, as well as my S&P 500. That's where I focus on my large cap growth stocks. And then my individual stocks, again, are the small caps. So I've been building up my positions in Green Lane Renewables. I've added around 20 or so shares over the past few weeks. I now have 225 shares. As my average cost is $1.77 per share. It's currently trading at $1.40, so I'm down 20%, which is quite a lot. However, this is one that I really think is going to be a $3 to $4 stock over the next few years. So I have no problem continuing to buy the stock and really bringing my average cost down because, again, this is one that is going to do really well. It's a renewable natural gas company, which is a sector that I think is going to see extreme growth over the next decade or so. So Green Lane Renewables currently makes up almost 3% of my portfolio. And the next growth stock that I've been adding to is Data Communications Management Corp. I've done a couple of videos on them here on the channel. I also sat down with the CEO, Richard Kellum, and got to interview him, which was great. So DCM is another one I'm really thinking is a great stock to hold for 5 to 10 years. It's currently trading at $1.07 per share. My average cost is $1.21. So I am down around 11% on this position. However, they have a PE ratio today of around 6. So this is a company that I think is extremely undervalued. And the company has some major clients. It has 7 out of the top 10 largest companies in Canada as clients, which is great. And they're currently undergoing a huge shift from a print company to a digital first company. And I really think this is going to grow their profit margins as well as their revenue over the coming years. So I continue to add DCM and continue to buy a few shares every single week. And now into my ETF positions, which if you've seen my last portfolio update video, you know have been the focus for me over the past few weeks. Each and every week, I alternate buying 1 share of VFV, which is the Vanguard S&P 500 ETF. So it tracks the 500 largest companies in the US, and it really just gives you a broad exposure to the entire US stock market. And historically has grown around 7 to 10% every single year since its existence on average. So this is one that you can just really count on as a long-term hold that's going to give you consistent and reliable growth, and really should be a backbone in any portfolio. So for this reason, I'm really trying to bring this position up in size to around 10%. It currently sits at 6.4% of my portfolio. So that is one of my goals over the next few months to really bring this position up in size. And along with that, also QQC.F, which is my NASDAQ 100 ETF. So it gives you a little bit more direct exposure to big tech, as it's only the 100 largest companies in the US on the NASDAQ. So this is a little bit overlapped with the VFV, which is the S&P 500, but it gives me more direct exposure to big tech, which I'm really passionate about moving forward. As someone who actually works in the tech space at one of these larger companies, I think it's a no-brainer to hold these ones. As technology continues to be a driving factor in society, I think these companies are only going to grow and go in the upwards directions. So I'm also trying to get 10% of my portfolio into this NASDAQ 100 ETF. It's currently 7% of my portfolio, so we still have a little bit of work to do there. Now that we've covered all the stocks that I've added to over the past few weeks, let's now touch on how my dividend income, or my passive income, I should say, has been growing by adding a few dividend stocks each and every week. So in my previous video, my average annual income for my dividends was just under $300 at $298.16. Today, it is currently $314.08. So we've increased this over $16 in the past few weeks on our annual income from our dividends just by adding a few dividend stocks each and every week, which is the end goal to really help bolster this passive income and grow that snowball to the fact where one day it'll cover all of our expenses and we'll be able to retire off of our annual passive income. So keeping this up over the next 10, 20 years is really going to allow this to grow to a point where we're actually going to be able to cover our rent and all of our expenses off of this income. And if we now look at this chart and see how my passive income has actually been growing on a month-to-month basis, you can really see how the growth is super steady on a month-to-month basis. It continues to get more and more passive income as we continue to add more dividend stocks. And as the dividends come in, we reinvest them into more dividend stocks. And that's that snowball effect that will continue to grow and start to grow faster and faster as we keep it up. In our first month back in March, we only got 63 cents in dividends. And now we're getting over $20 a month. We're currently sitting in September at $22.81, which is our best month to date. And if we actually look at the stocks that have paid dividends, somebody asked for this in my latest videos. So I'll actually go ahead and show the actual stocks that have paid out this month in September for anybody who's curious, which again makes up over $20 this month. And this is just going to continue to grow as we add to these stock positions and start to get more and more in dividends. So let's now talk about the portfolio breakdown and show all of my stock positions by weighting. You can see from the chart, and as I mentioned, TD is our largest position at 8.4%, really followed up by TELUS at 7.6%, AQN at 7.4%, but on average, the majority of my positions kind of fall in that 3 to 7% range, 3 to 8%. And that's really where I feel comfortable with a single individual stock position making up in my portfolio. I really wouldn't want to have any single stock more than 10% of my portfolio, just for diversification reasons. And if we actually look at my sector allocation chart, where you can see how much each sector takes up of my portfolio, the largest sector in my portfolio is the financial sector, which makes sense since TD is my largest position, and I also have Manulife, so this is 14.2% of my portfolio. And then I also have utilities at 12.6%. This is Algonquin Power and Fortis. And I also have renewables as one of the largest sectors at 11.6%, as well as my ETFs, which aren't necessarily a sector, but I like to just keep track of them along with my sectors. And my mentality and philosophy around investing into each sector is that I usually pick one or two stocks that I think are leaders in the sector, and I really focus on those positions in my account instead of trying to have 5 or 6 stocks in each sector. It makes it harder to keep track of research and due diligence on each stock that you own. And for that reason, I usually pick 1 or 2 in each sector that I think are really long-term winners. And now looking at my asset allocation chart, where you can see the breakdown between dividend stocks, growth stocks, and ETFs and how they all compare within my portfolio, you can see that I'm a majority a dividend stock investor at 65%, so almost 2/3 of my portfolio. And then ETFs make up 24.3%, so almost a quarter. And then around 10.7% in my growth stocks, which are my small cap stocks. So I primarily focus on dividend growth stocks that not only raise in share price each and every year, but also raise their dividends so you can really get more and more passive income and help that snowball grow. And then in terms of my ETFs, the majority of my positions, my ETFs, are where I hold large cap growth stocks. So through my Canadian Tech ETF, as well as my S&P 500 and NASDAQ 100 ETFs. So these give me great exposure to the US stock market and all of the large cap companies like big tech, etc. And then in terms of my growth stocks, that 10.7%, these are small cap companies. So 5 or 6 small cap companies that I've handpicked that I think are really going to outpace the market over the next 5 to 10 years and really just help to give that extra little oomph to my portfolio and help boost the growth in the long term. So these are 5 to 6 companies that make up smaller positions in my portfolio than my ETFs and my dividend stocks, as they are slightly riskier investments. And for that reason, you don't want to have too much of your portfolio weighted in these smaller cap, higher risk stocks. So for that reason, I only have 10.7% of my portfolio in this style of stock. And now if we jump into my weekly watch list for the week ahead, like I've mentioned, I'm alternating between every single week buying 1 share of my S&P 500 ETF or my NASDAQ 100. So this week I'll be buying VFV. I'm going to be adding 1 share, hopefully below $100 per share, as it has been swinging down below 100. So I'm going to be picking up 1 share of VFV over the coming week. I'm also going to be adding to another one of my ETF positions, my Canadian Tech ETF, XIT. This is just a great stock to get exposure to all of the largest Canadian tech companies in one go. So your Shopify's, your Constellation Softwares, OpenText, Enghouse Systems, you name it. You get exposure to all of these, and I'm super bullish on tech in general. And then in terms of dividend stocks that I'll be buying over the next week, you have Brookfield Renewables, BEPC. This is a renewable energy company that is currently seeing a little bit of a dip. It was trading around $55 a few weeks ago. It's now down around $50. So hopefully I can buy 1 share of BEPC under $50 in the coming week. This is one that I think is going to just do really well over the next decade or so as we start to shift more towards renewables, and we have to shift towards renewables if we want to help save our earth. We definitely have to make a change, and I think the renewable sector and Brookfield Renewables will help me take advantage of this shift. And then there's also Smart Centers, SRU.UN, a great monthly dividend stock that, again, I just add to every few weeks to help boost my monthly income. I always try to add it below $30 per share, as it has a tendency to swing down below $30, then bounce back up into the mid $30 range. So again, if it dips below $30, I'll pick up one share. And then the last stock I have on my list is PepsiCo. This is just a great dividend growth stock in the US. It has raised its dividend for 49 years straight. So it's a super reliable and steady grower. And this is one that I hold in my RRSP, so a retirement savings plan account. And the reason I hold Pepsi is because if you hold US dividend stocks in your RRSP, you actually have zero withholding tax. In a normal TFSA or a normal cash investing account, you usually see anywhere from 15 to 30% of your dividend income actually taxed. But with an RRSP, there's actually a tax treaty with the US. So they actually take 0% of the dividends in an RRSP. So for this reason, I hold my Pepsi in there. And I've just slowly been adding to it. I only have like 3 shares. So hopefully I'll add a 4th over the coming week. So that was my weekly watch list. And as you saw, my main strategy moving forward, my priority is really on adding to my ETFs, my large ETFs that are actually the US stock market and where I get the majority of my US exposure. So my S&P 500 ETF, VFV, as well as my NASDAQ 100 ETF, QQC.F. And really, I'm just alternating each week, picking up one or the other, as they are expensive stocks, trading both above $100 per share, which is around half of the deposits each week I make. I put around $200 in, so having a share that's over $100. And my goal is to really bring both of these ETF positions up to 10% each in my portfolio in terms of the actual weighting. And really, this is just going to allow a really backbone of growth long term, as historically over the long term, these are great ETFs to hold in your account. And really, as someone who has a long-term investing horizon in their future, so we're talking 30, 40 years until I plan to retire, these are really just great fundamental ETFs to hold in any account. So definitely ones that I want to build up my position in and really get my exposure to the US stock market and some large cap growth stock. Other than that, I'll really just be picking up some of my dividend stock positions that I'm down on currently. So Brookfield Renewables, as well as a few others. And this is really just dollar cost averaging while I'm down on these positions, as these are stocks that I plan to hold for, again, years and years to come. So really just taking advantage of when there are dips in these stocks and picking up some more shares. So that's really my strategy moving forward. I hope you guys enjoyed this video. If you did, smash that like button. And if you're new to the channel, make sure to subscribe. Lots more content coming your way. I'll see you in the next one.